Hello, everyone. You are on the Three Falling Crows channel. Today, while the market is trying to decide whether the medium-term declining trend that started at the beginning of the year is broken, or whether it will continue, I'd like to speculate on a more global outlook for the stock market. After all, the era of cheap money in the market has obviously come to an end, and it is no longer possible to rely on the market strategies of the past, which have given the investor a good return since 2008. The first strategy that failed was the buy on dips strategy. Yes, the rising trend in the S&P 500 index will only be broken when it passes the 3,000-point mark down, but look at the other aspect. The local downtrend has been going on for almost 10 months. There was such a prolonged decline in 2007, but not once since the 2008 crisis. The second strategy that has also started to fail is the 60-40 strategy, in which large funds allocate their funds in the proportion of 60% bonds and 40% stocks. Since the beginning of this year, we see a very uncharacteristic market situation for the last decades, namely the synchronous growth of rates in the bond market and the fall in stock prices. In such a scenario, the market does not have an asset that would increase investor funds during this period. And it becomes obvious to many market participants that simply leaving funds in cash is not the worst idea. On the chart, my 5-year bond yield is marked with a blue line. In my experience since 1996, I don't remember such a long phase of simultaneously rising bond rates and simultaneously falling prices. But the good thing is that we can look at the historical chart and notice that such situations were observed in 1970 and 1980, which coincided with crises on a global scale, and the crisis primarily affected liquidity and the debt market. It can be seen on the graph that the phase of simultaneous decrease of stocks prices and growth of bond yields has one peculiarity, and that is that the peak in bond rates is ahead of the bottom in stocks prices. Thus it is easy to conclude that until the peak in bond rates is formed, it is unlikely that the long-term trend for stocks will resume. But another consequence of rising bond yields will be that a return to high rates, among other things, will attract investors' money there, replacing their possible investments in stocks. And of course, high rates mean high cost of margin financing. Obviously, the continuation of this situation for a long time will lead to a reduction in leverage in the equity market. And not because they will stop lending on margin, rather the situation will be such that they will be less willing to take it. And summing up all of the above, I can conclude: the market still has room to fall, but the highs of early 2021 are unlikely to be reached in the short term. The trends will be equivalent for both growth and decline, and at least they will have a similar duration in time. By reducing leverage, the declines will become deeper and the recovery will be less rapid. And of course, the average level of volatility will grow, which is certainly a huge advantage. Happy trading, friends! Thanks for watching. Subscribe to my channel.